Welcome to Liquid, how CFOs outperform. I'm your host, Tom Gavigan.
And I'm Holly McNulty.
Today, Holly and I are joined by a special guest, Joel Campbell. He's the CFO of TreviPay. Welcome to the podcast, Joel.
Great. Thanks for having me today.
Before we dig into the conversation, I'd really like to start by asking you, so what's the current state of the CFO role and function as you see it?
Yeah, it's so interesting. I mean, I'm kind of later in my career and have grown up under a number of CFOs that I've worked under over the past 30 plus years. And I think the CFO role today is very different than it was when I started my career. And I think CFOs now are required to be more than just bean counters or preparers of financial statements. We are faced with a number of different things to help our organizations thrive. Particularly, I think back office automation has been, kind of this office of the CFO concept has been in the press and talked about for the past several years. So I think as a CFO, making sure that we're running our own shop well has become front and center, making sure we're thinking about all the opportunities to automate behind the scenes. And then I think, traditional things like liquidity management and managing our balance sheets well, whether you're building a fortress balance sheet or you're just managing your company to make sure you have the right amount of liquidity, that's always front and center. It dovetails right into, similar concepts around capital and capital management and using and allocating your capital wisely to help your business grow. I don't think those things have changed. But I think the largest thing that has changed is we've all become CFO plus. So when I was recruited by Corsair to join TreviPay 4 years ago, out of 30 years of working for public companies, I was recruited and hired as a CFO plus. And that means I have hands in strategy, I have hands in workforce planning, I'm involved in helping the board and in relation to governance, those types of things. I get involved with our customers and managing customer relationships and helping educate CFOs that we're trying to sell our products to. So there's more than just the traditional CFO role of things that we all think about, but now we're required to do so much more. And it's challenging, but I think for somebody like me who's kind of grown up working for really good CFOs that I've learned under, I was well prepared to come in and be able to take on and do more than just a traditional CFO.
That's super interesting. It's very much in line with stuff we see in the market. We kind of joke in a way that the CFO really means the Chief Futures Officer these days. It actually is a good segue into our first segment here, Joel. So when we look at CFOs, there's a lot of competition as finance leaders always looking to outgrow, outperform, outlast the competition. So here's where we like to dig into what we call the Chief Outperformance Officer. And I'll start with a question about being in the technology space, like we are at Kyriba and like you are at TreviPay. So seeing that you are working in a technology space as well as on the invoice to cash, what are you seeing in the market as it relates to corporate focuses in setting up working capital financing opportunities?
The prevalence now of particularly trade credit in the market has been a really interesting revelation to me. My background is largely having worked in financial services, insurance, money movement, the retail tax space. So I spent 25 plus years of my career working in financial services. I think the segue into TreviPay for me was getting more into the payment side of things. And particularly, we're focused on order to cash or the management of accounts receivable, which naturally has a component to it around liquidity and how do you structure liquidity in the right way. But I think for me, what I have seen over the years is just a stronger focus on trade credit, particularly. The strength of the underlying asset in the trade credit world, the accounts receivable, is getting much more focus and attention now than it probably ever has. There are new entrants in terms of banks that are willing to lend into this space and really like the asset class, particularly because as they lend against the asset class, they're getting not only, generally or traditionally a AA rated credit in the underlying receivable, but they're also getting an advance rate with a discount. So they're providing a 15 or 20% discount against receivables that you might be financing. So I always joke that they're kind of double protected. And I think because of that double protection, banks like this space. They understand the asset class, and they are now more and more willing to lend against it. So when it comes to actual working capital facilities, there are a number of different ways in the order to cash space and the receivable space that you can finance those receivables. Traditional receivables financing, you've got factoring, you've got the old asset-backed credit facilities, and then the one we deploy at TreviPay is a global AR securitization, where I take that AA rated asset and I'm able to securitize it and get working capital back for that I can lend out to our customers who need that capital or want to use that capital in a very, very efficient way. It's extremely complicated and complex to build and set up, but it allows you to offer a trade credit product or working capital product to your customer at a very favorable funding rate, particularly for those clients who need that funding and need it at a certain level. So I think there's just a plethora of ways to use these kind of AA rated assets to generate working capital in the right way.
And is there something to be said there about the current interest rate environment and the impact it's having on that, just as an alternative mode of borrowing as opposed to short-term borrowings and relying on credit as well? Is that what you're seeing in the uptick as it relates to this?
Yeah, absolutely. I mean, obviously, interest rates are something that, as a CFO and a former treasurer, I spend a tremendous amount of time kind of monitoring the capital markets, the debt capital markets, seeing what's happening with interest rates. But yes, as interest rates have swung up over the past couple of years, in a business like ours, we've been able to benefit from that. As interest rates now are coming down, they've come down 50 bips last week. It's likely they're going to come down and continue to come down through 25 and 26. Making sure that you're being thoughtful about how you're financing your business, first of all, and then for me, second of all, preparing and providing liquidity to our customers and working capital. I have to be very thoughtful about what interest rates and the impact that the changes in interest rates are going to have on my revenue stream, on my the liquidity I'm providing to my customers, the pricing that I put in place around the liquidity that I'm providing to customers. All those types of things we have to factor in as we start to watch what will happen with interest rates over the next kind of 18 to 24 months.
So what would you consider your greatest advantage as a leader driving innovation from the office of the CFO?
Yeah, I think for TreviPay, one of the greatest advantages we have is we have a very modern architecture for our platform. And so we work in the order to cash space. And so in the order to cash space, you typically have a very simple cycle. There's an order that is placed between a seller and a buyer, and the buyer is buying products or services, whatever it might be. So there is an order that is placed. We're capturing that order. Once the order is captured, we're determining if we're going to offer terms to the buyer. Already have a relationship and built with the seller and offering them terms, but offering terms to the buyer. Once that is determined, we then raise the invoice. Once the invoice is raised, we collect the cash as the cash comes in, and then we apply that cash in a very efficient format behind the scenes to, again, open those lines of credit that we've established with those buyers and allow them to buy more product. So I think what's interesting about TreviPay is we serve the entire order to cash cycle. There are many, new entrants in this space. There are existing companies that have been in the B2B payment space for a long time. They may only have slices or pieces of the order to cash cycle, but I think what's unique and innovative about TreviPay is that we serve the entire cycle. And then on top of that, we add the opportunity, if you need it, to use working capital to get liquidity to fund the purchase by the buyer into the seller. We have working capital we can offer that buyer on terms that traditionally they can't go get somewhere else, or they can't find from a banking partner, or don't have the liquidity on balance sheet to manage themselves. So I think we have we call ourselves a bit of a unicorn. And I think the fact that we couple a really modern order to cash architecture with a lending component for those customers who need it sets us apart and makes us very different and innovative in the B2B payment space.
So that's really interesting to hear your take on that. And continuing along those themes of innovation, what innovations are you most proud of, or what are you most excited about, that's coming down the pipe as far as innovations go?
Yeah, I'll take maybe the second part first.
Okay.
Clearly generative AI is getting a ton of press in the market.
Mhm.
I think, AI is going to be really interesting in the future, the next several years as we figure out how to deploy it in the right way, whether that's in our business or just broadly in the market. But the thing that's interesting about AI is it doesn't replace human thought. It doesn't replace human action or capability. And our ability to synthesize a ton of different information that we get every day to help us run our business better, to make better business decisions. So I think there is a place for AI, particularly in the B2B payment space. I think there's a place for AI. I'm not convinced today that AI is going to come into the business world and dramatically change everything. I still think that there's a ton of human reason that is involved in what we do in our space and what other companies are doing in their spaces. And then maybe the first part of your question, just in terms of TreviPay, I think we're really proud of the platform that we've built. We're not a kind of fly by night. We're not a new entrant. We've been in the market for 40 plus years. We've had a B2B payments platform that we've morphed and changed and grown into now being a much more modern stack in terms of its architecture and how it functions. And I think for our customers, particularly, we have built features and functionality in the different verticals we work in to really kind of stand out within those verticals. I'll just give you one quick example. So in our retail vertical, we have a couple of large retailers that we are their B2B payments and business platform that sits behind their business. One of those retailers sells into the education space. And selling into schools and school districts is, pretty straightforward when you're selling electronics or other types of products. But the billing and the invoicing and sending it to the right place within the school district, making sure that it goes into the right budget, all those types of things that sit behind the scenes that we have built over the years set us apart. So we know the education space. We know how the education buyer wants to buy from a retailer in terms of the products, but then we also know how to help that education, that school district, make sure they get the right invoice, that it goes to the right central processing place, that it gets paid in the right way and gets allocated against the right budget. It seems like a small feature, but when you're in that space as a retailer and you're trying to sell into a very complicated local municipal school districts, it just sets us apart as something that we built. And we have built dozens of intelligent network apps, is what we call them. We built dozens of those for our different verticals to specifically target and support what they're doing in their businesses to help those businesses run better and help them grow.
Well, that's certainly something to be very proud of.
Joe, I wouldn't mind double clicking a bit on the AI conversation quickly because it is such a hot topic, right? And I think right now in our world, it's met with a lot of varying opinions in terms of the direction it's taking. You mentioned along the lines of it not being too disruptive, but I'm curious, like, what's your time horizon on that as you look at it and its impact in our world? Are you talking about over the next 5 years, or you're talking longer thereafter? I'm just curious.
Yeah, it's a great question, Tom. I mean, we got asked this question by our board of directors a few board meetings ago, and CEO and general counsel and I kind of looked at each other and like, yeah, we're thinking about it. Like, we know that it's out there. We know we need to do something. I think in our business particularly, there are many applications for AI in our business. I think the challenging thing is it's a great question. What is the time horizon? There are products in the market today that we can use as consumers. We can do searches. College students can write papers using AI if they want to now, and that's become more prevalent. But how do you take that capability and apply it into a business setting, I think, is the bigger challenge. So I think to answer your question directly, I think it's probably a 3 to 5 year time horizon before you start to see AI really embed itself, particularly in our space, in embedded finance, to find a way to embed it in the software that's helping you make more intelligent decisions, maybe in a much more expedited fashion, to be able to support what you're trying to accomplish for your customers. I do think that there will be a place for it, but I do think it's probably a longer term conversation than maybe a near term conversation.
No, I think I agree. I think I agree. It's gaining its maturity and structure around it, I think, is what's going to then lead to the longevity of it and the impact it can have in the next 2 to 5 years. I think also the human element of the comfortability around it is something we see as well in the market. People are willing to allow AI to do the various monotonous operational things that they do day in and day out. But when you look at and explore ways in which AI can be used to perform the more strategic things, like perhaps managing a working capital program or managing your investment positions or borrowing decisions, that the human element is saying, hold on, that's a bit that's maybe a step too far. But the reality is that we will get there, right? The technology is going to get there, and the humans are going to get there as we look at ways in which we can grow and mature the technology, as well as make sure that the compliance is also in place around the technology being used to do that. So it's always an interesting topic.
Yeah, we can't ignore it. I think you're absolutely right, Tom. We can't ignore it. But there are multiple facets that we have to think about in terms of the impact to our business before we're ready to, for me, hand on heart, to sit in front of our board and say we're ready to roll out AI into our software. Right? We're just not there yet.
And nobody, that's the thing. It's been talked about, I think, so for so long, actually, right? For years now, in a very kind of superficial way. And I think now technology companies like our own are like both of ours are going into it, but you have to do it in a pragmatic way, especially for the sensitivity of the things that we ultimately manage.
Well, to close out this segment, what's something that you wish more people in your organization knew about your treasury team?
Yeah, it's an interesting question. We have a really small treasury team. Having been a treasurer at some very large public companies over about 25 years, I had treasury teams that were already 20, 30 people. We are a reasonable size kind of mid-market business that is growing quickly. We're at scale and we're adding scale every year. My treasury team today is made up of 3 people. We have 2 staff people, a manager, and then on top of that sits a director that reports to me. So we have a really small team. But I think the really interesting thing is, we're very modern in the way we do treasury. We have a treasury workstation that we've implemented. We've migrated through implementing that treasury workstation straight to Swift. So we do everything through the Swift communication protocol. We are, setting our cash position, doing our cash forecasting, managing thousands and thousands of payments on a daily basis, all through very sophisticated software. And I think for a smaller company than where I've come from, to have that level of technology and be able to do things in a really robust fashion is a little bit unique. There are other companies our size that I'm well aware of that are still doing their cash management in spreadsheets and through banking software and through traditional banking platforms. But I think the evolution of systems like Kyriba and other vendors that are out there have allowed even small corporates like us to tap into very sophisticated software to help us get more efficient in the way we run our business. So I can have a small treasury team is what I'm coming back to, because I have software and capabilities around that software that allow us to run really lean. And I think in a business like ours, running lean and investing back into the product, investing back into the customer relationships we have is the right way to run the business. And I think software has allowed us to be able to do that.
Couldn't agree more, Joel. I think that's what makes it so exciting for the worlds we both live in. The barriers to entry for what we offer have become so low and accessible to help organizations large and small, especially in a SaaS-based world. So completely agree with you on it. I want to shift gears and go into our next segment. We've all got secrets, and today we're going to hear it directly from our guest. I want to dive into this next segment, which is our CFO Secrets segment. And Joel, when we were prepping and talking, I think this is probably one of the most interesting questions that I was excited to kind of dig into and learn a little bit more from you on, because you have good perspective on it. Since you've worked both for public companies and now work for an organization that is private equity held, can you describe some of the differences you've observed in how liquidity is managed differently in these 2 different environments?
Yeah, sure. Having spent 25 years working for large public companies, I can tell you that in a large public company, not only are you faced with managing liquidity well. In all the companies I worked for, we were building fortress balance sheets. I grew up in working for a large insurance and wealth management company that happened. I was in Treasury at the time of the credit crisis, and understood very quickly in managing both liquidity for the corporate as well as managing liquidity for our customers, the importance of making sure that you had the right liquidity structures in place to supply it when you needed it. And I think at a public company, you're much more focused on, at least from my perspective, on the capital markets, particularly the debt capital markets, managing your debt structure well, making sure that you have the right liquidity facilities in place, whether that's revolvers or other types of short-term, near-term liquidity. But you're also heavily focused on the overall balance sheet. I juxtapose that against being in private equity. In private equity, you're still focused on liquidity. I mean, cash is always king. That's never going to change. You have to have cash to be able to run your business. But our liquidity is structured very differently, and it's structured because we have a private equity company that has provided capital into the company at the outset, and over time we're managing that equity to their standards. They have a longer term time horizon than the quarterly shareholder time horizon that a typical SEC registrant is facing. So I have some flexibility, if you will, in managing my liquidity in the right way to support the business. But in terms of the longer term liquidity that the company needs, I can structure it very differently because I have a perspective from our private equity owners that has a much longer term time horizon that is looking for capital return over time and therefore has a different view on how we manage liquidity. I actually structured our liquidity so that we carry some extra cash on the balance sheet at all times. As a small company, being prepared when something happens, when there's a market divergence or when there's some disruption that comes along, our ability to have some extra cash on hand to support our customers and to manage our business well is extremely important.
Yeah, being able to have that agility is very it's very crucial in your role and in the role of the finance and treasury teams. One thing that we see a lot at Kyriba is, there's this convergence between the office of the CFO and the office of the CTO, especially when it comes to technology and automation. Can you share with us your strategy for working cross-sectionally with CIOs and CTOs?
It's interesting. I mean, I hadn't spent much time with CTOs in my prior life. As a treasurer, you don't typically spend a lot of time with your technology folks, other than when you're clamoring for dollars to buy your own technology. We're much more thoughtful about the entire suite of the product that we're offering. And obviously, in offering working capital to a subsection of our sellers, our network sponsors, and their buyers, we have a different view on managing liquidity as it relates to our modern technology platform. Our technology officer and I probably spend more time talking about those types of things than I ever have before. I don't know that I'm necessarily seeing a convergence between CFO and CTO. What I see more is a collaboration and partnership. That as we're building the software, particularly as we're targeting new customers and prospective customers, that we're building the software to be able to help us see what liquidity might be needed, forecast the tactical liquidity we might need to support a customer, and then from there, helping me then be able to set direction as we manage liquidity going forward. As we think of particularly of some of our prospective clients that we're targeting today, liquidity is front and center as part of those conversations. The other thing I would add, Holly, is that part of my role has become with the technology team is helping educate CFOs or treasurers that now sit on the other side of the desk that are buying product from us and helping them understand if you're getting pressure to move liquidity off your balance sheet, you still have to pay for that liquidity somewhere else. I can help you understand how to do that and how to structure it. But as those CFOs and treasurers are getting pressure to manage liquidity differently in their companies, I think I have kind of a unique perspective to be able to jump in and help them understand how I see managing liquidity to support their business through the product that we offer.
I'd agree. That's what we would typically see as well. And on the other end of that table, the input required from the CIO, CTO to ensure that the technology track that you're headed down is in accordance with your internal policies and compliance and rules that are set out. That's such an incredibly important part that sometimes isn't understood until later on, and that could have such an impact on the decisioning or the direction that perhaps the finance team is going, but the technology team might not have wanted to go, that we oftentimes see.
I probably spend an inordinate amount of time thinking about future cash flows and making sure the business is resilient and that we have liquidity. Part of that is because of my training and background. Part of that is because I have this kind of unique experience of having managed liquidity in four very different types of public company businesses, and now managing it on a private equity side when you're not only managing your own, but you're managing liquidity to provide through the product channel itself. And that's a little different than what I've done in the past, but I think it has allowed me to kind of have a unique chair, a unique seat at the table as I think about how to help our customers think about managing their liquidity as it relates to the order to cash cycle.
I think that's actually a good entrance to the last question I would have on this. You've kind of shared some of these already, but if you could summarize, give us some insight into your secret sauce in your current role at TreviPay.
Yeah, I think there are a couple things related to our secret sauce. One of the things that typically happens when you outsource or when you buy an order to cash platform like ours is you typically are displacing an in-house program. And that in-house program typically comes with customer support, it comes with cash collection, it comes with the application of that cash. Do you open those lines for your customers to continue to buy from you? So when we take that on, we take that very, very seriously. And we have dedicated staff to each of our individual networks and programs that we're running. But there's some secret sauce there in really understanding your customers well, understanding what their pain points are and how you address them. When you're working in your own company, everybody kind of knows everything about that company and what the pain points are. But when you outsource it to a company like us, and today we're running 66 plus networks for different companies, we really have to learn and understand what the pain points are for each one of those clients and allocate customer support, cash application, cash collection capabilities against those specific pain points to make sure we're addressing that for our client. That's a big part of the secret sauce at TreviPay. It doesn't get a lot. I bring it up honestly because it doesn't get a lot of attention. We all kind of think of them as back office. They sit somewhere else, and we don't interact with them much. But they are in the front lines of doing this for our customers, and it's extremely important that we get that right and that we take care of our customer in the right way.
All right, Joel. I guess last question we would have, and this is one of my favorite questions to always ask anybody that's joining the show, is you're not a CFO all the time. How do you decompress? What do you do outside the office? Share a little bit more about Joel Campbell.
Yeah, I do feel, Tom, that I am a CFO all the time. So
we've heard that before. That's the thing we keep hearing. Actually, is we get that.
Particularly working in private equity. I mean, when you're trying to grow a business fast and you're involved as a CFO plus in a number of different things, it feels like I am a CFO all the time, but I'm not. So outside of work, I really I'm a big family guy and always have been. I love to focus on and spend time with my family. My wife and I are now empty nesters. 2 kids that have graduated from college and are in their early steps of their careers. So kind of reconnecting and finding things that we like to do together after, managing a household and kids for 20 plus years. We both love to travel. We lived overseas, and one of my posts and early in my career, we had a chance to live in London for 3 years. And I think that gave us the bug to travel. So typically we have some sort of big trip every year that we take, and kind of whether it's a family trip or just the 2 of us, there are places we like to go and things we want to see that are still on the bucket list. So that's another one. And then lastly, I think for me, I do a lot of business reading naturally kind of throughout the course of my day. But I think one way I kind of escape and get away from some of that is I love to read John Grisham novels. I'm current on every novel that John Grisham has ever written. And I love it because it just gives you a chance for me to live in a different world and kind of see things from a different perspective. So I love to read. I love to travel. I love to spend time with my family. Outside of that, I still am kind of a CFO. Even when I'm with them, sometimes I'm still kind of a CFO. But those are the things I love to do outside of work.
Outside of Grisham, any recent books that you would recommend?
Yeah, there's one laying here on my desk called Range by David Epstein. It's a book that our CEO had the executive team read, and it's all about particularly in our space, about disruption. What's happened in disruption in different industries over time, and how, as a, I am a specialist in finance, and I've been in finance, my entire career. But how to take that specialization and give yourself range to broaden your horizons. I kind of talked about this at the beginning as a CFO plus. I think my ability to synthesize finance information is kind of natural. I've been doing it forever. But my ability to then take on and manage other things that touch the CFO or touch the finance organization, having more range and getting more broad over time is something that I'm focused on personally in my own development. But I think as a private equity CFO, being able to help my company get some range and broaden its horizons in the way we think about things over time is also really important. So it's a great book. It's a little bit of a challenging read, but if you stick with it, I found it to be a great book.
Joel, really appreciate the time here. It's we've come to the end of the segment, and I want to thank you so much for being here. I think it was a really good conversation. I guess finish up here, and how can our audience stay up to date on what you're working on?
Yeah, I'm on LinkedIn. I think probably is the most pervasive thing for most folks. I'm on LinkedIn. I have a presence on LinkedIn. We've got a number of different things we're doing at the company. We have a conference that we're hosting in Kansas City called Crossroads. It's about bringing B2B payments industry expertise into a room and talking about what's happening in our space. I'm also part of the board of the Association of Finance Professionals. We have our upcoming AFP conference here in just about 4 weeks. I typically host a couple of sessions during that, and they're participating as well. But the most easy place to find me is on LinkedIn. I try and be disciplined about being on LinkedIn at least a couple times a week to check in and catch up on things. I think it has become a great tool for not only having a presence, but to keep in touch with what other people are doing in your industry. And it's been a great process for me.
Well, that was such a good conversation with Joel. I appreciate so much having him on here. Holly, I'd like to start with you. What were your thoughts on the conversation today?
So the first thing that really comes to mind is when he was speaking at the beginning about a CFO role and how it's more of like a CFO plus role. So it's not just, a CFO like overseeing everyone else's
I think
activities.
I think it said bean counter at one point.
Yeah. It's not the bean counter. It's having that, strategic relationship and being a mentor to your team and really having that hands-on focus. And I think that's just it's a really good way to put it, that CFO plus. I liked that.
Yeah, and that's what we talk internally. It's what we call it, the Chief Future Officer, because of their involvement, not just in the retroactive analysis of the company, which we are so accustomed to, the financial statements and the audits and the balance sheets and income statements. It's so much more in terms of the direction and the strategy that the company is going, and the importance and criticality of the CFO role that we see in the market today. I think he was a unique guest because of the background he brought and he shared with us. The way in which you have to operate differently for managing the financials of a publicly traded company versus that of a private equity, a company held in private equity. The pressure is still there, but one of the things I thought was interesting is just like the time horizon that they're focused on, where obviously he's right. When you look at public entities, they're living in 90-day increments in terms of what they have to report on and how they're ultimately measured and how the market perceives them. Whereas within private equity, these are assets and investments that are held for a longer duration, and it gives the CFO a way in which to manage liquidity perhaps in a different way. But what was also interesting, and something we also see in the market, he was talking about how they keep more cash on hand within their organization. Cash is king, and we couldn't agree more. But that's also something I see in the medium enterprise industry now. One of the things with the excess cash sometimes we are seeing now for what we would consider the medium enterprise, the small medium enterprise companies, is perhaps putting in place dynamic discounting programs, deploying that cash to pay vendors early perhaps, or finding ways to do that. And also I just appreciate it's nice to kind of talk to Joel because he's very similar to what we do in terms of he is in finance, but also in technology, and that bridge that we see with the technology team and the finance team and how they ultimately we work together. It was good conversation. Looking forward to the next episode. Thanks for tuning in. To never miss an episode, subscribe wherever you listen. I'm Tom Gavigan.
And I'm Holly McNulty.
And this is Liquid, how CFOs outperform.